In this chapter, we're going to be introducing accounting in business. So we're going to talk about the importance of accounting, who uses accounting, just why it's here, why we have accounting in a business curriculum. Whether you're going to become accountants or not, whether you're just going to be managers at a business, we'll see how accounting is still important. So let's talk about the importance of accounting. Accounting is an information or is a system. It is an information system that identifies, records, and communicates information that's relevant, reliable, and comparable, and that information is about the organization's business activities. So we're identifying, recording, and communicating this type of information to some sort of user, and they're going to use that to make decisions, business decisions. So we're identifying business activities, transactions. We're going to look at sales. We're going to look at bills that are paid, a lot of different things. We're going to record those into the accounting records, and then we're going to communicate this information to other users, whether it's outside of the company or within the company. That takes us to the users themselves. The main focus of a financial accounting course is external users, people outside of the company that need to know information about the company. The two main ones would be lenders. It could be a bank, it could be bondholders, or shareholders. These are owners, these are investors, stockholders. We do have other groups, though, outside of the company. Governments want to know about how the company's doing for tax purposes, for SEC, Securities and Exchange Commission purposes. Customers want to know about the company. Are they going to be around in the near future? External auditors help through the audit process, and consumer groups. So those are all external users, the main focus of a financial accounting course. But we also have internal users, people within the company that they do have access to the records, but they're still needing some sort of reports summarizing that information. So anybody inside of the company, managers, officers, internal auditors, all types of employees. So again, financial accounting is the focus, or external users are the focus for financial accounting. Managerial accounting, another type of accounting course, focuses in on internal users. So it's all about making decisions about the company. Various opportunities in accounting. We have a few quick examples here. We have financial accounting. We have managerial accounting. You have taxation, which actually taxation is probably the most familiar to everybody else, because as soon as you start your very first job, you have a tax return. So you're familiar with the idea. You certainly know that tax relates to accounting, but you can see there are several different types of opportunities under each of these categories. And then we have a lot are just related to accounting. Lenders, consultants, analysts, traders, appraisers, forensic accountants, just several different types that are related to accounting. If we break down the various jobs by area, private accounting makes up 60%. This is where you work for an actual employer. You work for a company and you're in their accounting area. Public accounting is when you work for a public accounting firm and you audit clients. So in the public accounting area, you may be auditing these private accounting folks. Then you have the government and not-for-profit and education. So a lot of just miscellaneous type jobs there. This is just a quick breakdown to see or to show you how they spread out a bit. Ethics. It's an important concept for any accounting, any business course. This is basically an understanding of what's right or wrong, not necessarily what's legal or illegal. Legal or illegal, although ethics sometimes follow those laws, those rules. They don't always. There might be something that is legal. It's technically legal to do that, but it's still unethical. In other words, it's still maybe not the right thing to do. It's a wrong thing to do. You'd be a little ashamed if this made the newspaper the next day. So it's just not what society expects. It's not what your peers expect. It's the wrong thing to do. You're cheating someone. Again, maybe there's not a law against that particular activity, and that's the reason for that is you can't regulate every single little tiny thing. Your law books would be several times huger than they actually are even right now. So ethics is just generally what's right or wrong. To have a guideline for ethical decisions, you identify what concerns do we have. Is there something that may be gray here? Is there something that we have a concern with, period? Analyze your options. Which option do you take, A or B, or maybe there's even a C? Consider both sides of each option. There might be good parts about it. There might be bad consequences to those options. And then, based on all your data, choose the best option. So, now it's easy to put this out on paper, on a PowerPoint. When you come across an ethical situation in real life, it's not one of those easy, clear-cut things in many cases. There are a lot of gray areas, and you really have to evaluate what is best for you and for the company. What is the right thing to do? Might not be the easy thing, and many times it won't be the easy thing to do, but it's one of those things you just have to really think strongly about it. So now we're going to start talking about the rule-making process under financial accounting. We have a term here called GAAP, Generally Accepted Accounting Principles. This term encompasses all the rules, all the concepts that we follow. The term GAAP is itself pretty general. So when you say GAAP, you're just saying any type of rule that we have in accounting, it's under GAAP. So we want relevant information. So we want information that affects the decision of its users. Those users need this information to make a decision. It's relevant to the decision at hand. We want information that's reliable. In other words, they can trust it. It's reliable. They don't have misleading information. They don't have false information. It's trustworthy information. And we want it to be comparable. In other words, we want to be able to compare this year to last year to the year before that. They use the same measurement methods in all those years. So it makes sense to try to compare them. Now, across companies is a little bit more difficult because sometimes company A may use this accounting method and company B uses another perfectly allowable method, but it's different. FIFO, I know you may not have talked about inventory at this point, but there are various methods of inventory. We have FIFO, first in, first out, LIFO, last in, first out. We have weighted average. I'm just throwing out a few examples. There are 4 common methods of inventory measurement. So let's say company A uses FIFO, company B uses LIFO. You might not be able to compare their inventory or their cost of goods sold as easily. That's just one thing you have to take into consideration when trying to compare those two companies. Are they using different methods? If so, you have to think about what that means. What do each of those methods mean? Do you expect a number to be higher under one method or lower under another one? So who is responsible for setting accounting principles? So in the United States, we have a government agency called the Securities and Exchange Commission, the SEC. Under Congress, or I shouldn't say under Congress, under our government, under the 3 branches of our government, these agencies have the legal authority to establish these reporting requirements and set gaps. So they have the right, they have the legal authority to create these accounting principles for any company that issues stock to the public. So they don't have the right to do anything for any company that wants to operate just on their own. They don't issue stock to the public. It's a private company. They don't have the they don't have the authority to regulate them, but they do have the authority to regulate companies that are on the public stock exchanges. In other words, they're protecting the investors to make sure they get the accurate information. Now, even though the SEC has this legal authority, they've delegated it since the very beginning down to a private group. The private group that currently is in play is called the FASB. They've been around since the late 70s, the Financial Accounting Standards Board. They set the broad concepts and the specific principles that we follow in accounting. Now, what I'm saying by that is that the SEC has delegated that authority. They still keep that authority, though. They still have the power to override the FASB if they don't like a particular rule, but they haven't used that. They're kind of an oversight type entity. So the FASB is really who we see these rules coming out of in the United States. We do have another board I shouldn't say we, there is another board called the International Accounting Standards Board, the IASB. As you can imagine, it's international. Several countries, now they're saying more than 100, either require their companies to use international standards or they at least allow them to. The United States currently does not. The United States, the FASB, the Financial Accounting Standards Board, has been working with that International Accounting Standards Board for several years to try to get closer and closer to harmonizing the two sets of standards. They haven't got there yet, and it's one of those things where the decision has been pushed off for the past few years. Most recently, it was supposed to be made in 2012. There was supposed to be a decision made as to whether the United States would adopt international standards and when. That was pushed, and there is no timetable at this point as to when we'll know. So just information on the international standards. It may affect us in the future. Now we have some principles we're going to look at. Principles and assumptions in accounting. These are things that you don't need to memorize a definition per se, but you need to understand what the underlying spirit of that rule is. So we're going to talk about all these. We have something they call the measurement principle, also referred to as the cost principle or historical cost principle. This tells us that when we purchase an asset, we record it on our books at the price we paid to buy it. Not necessarily how much it's worth at any point in time, but rather how much we actually paid then and there to buy that asset. Historical cost. We don't update it to fair market value. Now what I want to mention here is that a lot of these have exceptions to them. We're going to find some rules in accounting that have exceptions or they're allowed to be bent a little bit. Some rules have absolutely no exception. So these ones all right here, there are exceptions. These are the general rules, but there are exceptions to them. Revenue recognition principle. This is a difference between the accrual basis of accounting that we use for financial statements versus cash basis accounting. Under cash basis accounting, we're saying we recognize revenue when we get the cash. We recognize an expense when we pay the cash. Under accrual-based accounting, we recognize revenue when it's earned. Even if we haven't yet collected the cash, if we've earned it, we've sold the product, we've provided the service, we've earned the money, it's just that we haven't collected it yet, we can still count it as revenue. The matching principle is kind of the flip side of that. This is expense recognition. We're saying that we want to match the expenses in the same period as the corresponding revenues. So what we're saying here is that the only reason we have these expenses to begin with is that we're trying to keep our company running. We're paying these bills to keep our company running, and we're generating revenue. So those expenses in most cases relate to a certain period's worth of revenue. We paid bills to operate during this year and generate revenue during this year, so we want to match those expenses in that same year. Full disclosure principle, that simply says, give us all the information we need to make a decision. Don't try to hide stuff from us as investors. Going concern assumption, this tells us that we're presuming that the business is going to continue operating into the future. We don't have any information telling us they're going out of business in a few weeks or next year. Monetary unit assumption, that just says we're going to express our transactions in money, and it'll be the currency of the country you're working in. So that's how we express those transactions. That's how we record things. It's in monetary form. The time period assumption, that basically says that we want to divide the life of this company into certain periods. Could be years, could be months, whatever. We want to divide that life of that company down that way. The business entity assumption, this basically tells us we want to separate our company from the owners financially. So in other words, we want to record a person's checkbook. That's not going to get into the company's financial records. We want to separate it. It doesn't necessarily mean there's a legal separation. It means for financial purposes we're separating them out.